Hello, everyone, and welcome back to the VectoScalar Tech Talk show. In this show, we had some technical glitch in the beginning, so we started a bit late, but that's okay. The good thing is that we are having an amazing speaker, Manpreet Kaur, who is going to talk about how to simplify the business valuation part. Welcome, Manpreet, to the VectoScalar Tech Talk show.
Thank you, Vikas. Thank you for having me.
Yeah. For the benefit of audience, let me brief about Manpreet and her experience into this field. Manpreet is a CA and certified valuer by profession and has worked in equity research and debt syndication for 10 plus years. Presently, she offers consulting to small and medium scale entrepreneurs to help them understand their company's financials for decision making and help them establish their exit strategy. Manpreet, business valuation these days is very critical. What's your take on it? And for the benefit of audience, could you explain in simple word what is business valuation to start with?
Yes, of course, Vikas. So, business valuation is think it like giving a price to a business. So, if you and I go on the stock market today and we want to buy a business, in the stock market, the price is already there, but we need to find that is it the price overpriced or underpriced. And let's say if we talk about and you come to me and say, Manpreet, sell your business to me. So we need to identify, okay, what price? So what is my aspiration? And I was like, okay, because give me this much $1 million. But that's not fair. We need to see that what I'm asking for as a selling price is justifiable by my business, that it can generate more returns for you in the future. Otherwise, why would you buy a business that's going to go down the road and it's going to only incur losses? So simply,
Right.
business valuation is about understanding what is the value of your business currently if you want to sell it outside in the market.
Okay. Okay. That seems like a simple definition, but as we all can understand that the equation to find the business valuation could be pretty complex. So, what are those factors that impact the business valuation or play that role in business valuation part?
So I will not go much deeper into the complicated formulas, where there are three major approaches we use. One is called discounted cash flow method, where we take the future projection of the cash flow, that how much cash your business will generate, and then we'll discount it at the growth rate we have taken, and then that comes with a value. Second is market multiplier, where I say like, okay, if I want to buy your business, I will look your competitor business in the same industry, same niche, same segment, and I will see, okay, what price they are selling. So if they are selling for 5x, let's say five times profit, five times of the profit, then I will ask you, because that your competitor's business is currently valued at five times of their profit, so I will like to pay you that much only. That's your valuation as well. And the third method is purely on the books, what the books, the financial statements are telling that current value of the business is. So we look at the all three approaches, and then we also calculate an average price based on that. But that's just the financial part. That's just the financial valuations are carried out. There's more to it as well, that when you are looking for a business, that's you understood one thing, that okay, this much price I will give and I get the business. But I think it comes into the more consideration that what kind of business you're going to buy. So if I say that, okay, Vikas, let's say for example, based on all three approaches, the price comes at for my business is 10,000. So just a round number, easy number for everybody to adjust and understand. It's a 10,000 rupee number. Now, it's not just simply the act of you giving me 10,000 and taking my business. You also want to understand that, but Manpreet, do you have a team? Because if I don't have a team, whatever I'm doing is now you have to do. That's another operational labor on your part, which going to cost you time and everything. And the second question you want to ask me is, Manpreet, is your business risk assessment is done. Is there market growth potentials are there? Because why would you pay me 10,000 today and take over my business if my business has no growth potential in the future? So you also want to understand that, do I have the growth potential? The third thing is, with team, it comes also the factor that company culture. So the moment you take over, the transfer of the ownership gonna happen. Is my team gonna work with the same sense of loyalty and same sense of aspiration for the business where they were working with me? That again becomes a part of how strong that team and culture was. Another thing is also risk assessment. So how minutely I have defined all the SOPs in the business and all the potential risk, and do I already have established systems in my business to capture those leakages that can happen? So all, and another thing is also brand value. So if I have a huge brand, let's say Apple's purely valuation does not derive from their book number, but also what that brand equity it brings. So that we also need to account into the thing that if you're buying my mobile company, you may be like, okay, I'm giving you just 10,000 rupees. But if you're buying Apple, you're buying that brand as well. That brand has a
Yeah.
present significance and you already have a established base. So these are all non-financial parameters that is also that may directly not come into the valuation part, but when a person is thinking of their exit strategy from a selling point of view or buying point of view, as an entrepreneur, they do think of these considerations as well.
Okay, okay. That's a beautiful insight that there are some objective numbers like book
Mm-hmm.
values, and these are
Mm-hmm.
the, then there are some subjective numbers like things like operational cost, team, risk assessments, the potential growth parameters, and last, as you talked about, the brand value. But
Right.
for the, especially for the subjective term, let's take an example
Mm-hmm.
of a brand value, which
Mm-hmm.
means that if there are two assessor for a same company, can they come
Mm-hmm.
out with different valuation altogether, like 5-10% here and there
Definitely.
is one thing. Yeah.
Definitely. Even when we talk about the financial number valuations, my understanding of the business and the growth rates and the risk discounting I am making based on my understanding of your business. And for you, if you are doing also the same thing in parallelly, could be really different. So we our own slide number could differ even in the financial aspect. And on the non-financial aspect, it's purely subjective. What I feel like a very well nurtured cultured team to me may sound like a very overly lenient, overly tight knit team system which is there. And you feel, if you are a person who do not like systems, like everything has to be followed by written documentation, then you're going to feel like there's no freedom to innovation or freedom of choice for people to just do whatever they want to do. So I don't consider it a good culture. While parallelly, somebody who likes those kind of things, that everything is defined, each and every action step is defined and measured for people's performance, they're gonna feel like, oh, I like that. I like the idea because I'm that kind of person. So yes, personal beliefs also get into the picture of those non-subjective evaluation parameters.
Okay, so subjectivity matters. And
Yeah.
taking this conversation further, Manpreet, when we talk about especially the technology companies, so we have one set of companies that are into providing services. For example,
Mhm.
VectoScalar Technologies itself into
Mhm.
providing custom software development services. And then
Mhm.
there are companies that are into product development. So
Mhm.
the business valuation remains the same for service or product company, or the dynamics changes?
I would say the fundamentals of calculating valuation still remains the same, because it's how you calculate the value for a manufacturing company or a retail company, a service company, a government company. The only thing is change is the risk factor, the growth potentials, and the fixed and working capital cost involved that impact the profits number. So maybe in a product centric, there is more cost number happening because you're developing the product and there's continuous testing is happening. But on a service side, margins are more because while you're giving a service, most of your expenses is just on the manpower. Either you're if you're delivering it on your own and you're just a single person delivering, it's just your expenses, your salary you're taking from the business. But if you have a little bit of team, it's their salary expenses and just administration expenses. There's not much going on in the research and development and testing costs and all those costs. So I would say the basic underlying factor remains the same, because we always take the profit number, the cash flow numbers. Even when we multiply, we look at the profits, like okay, how much profit it will be in the future. But internally, between service and product, the only differentiation will be how much product is needed, what is their market share will be in the future, how much is the growth potential, is there even a need of this product, and for the service as well. And whatever difference comes is the common their own percentage to percentage requirements.
Okay, that makes sense. That makes sense. That definitely for the over like what kind of annual return that business is making could be different, but definitely
Yes.
I also agree that for a service company, if you're serving 100 clients and if you have to take to 10,000 clients, you will need bigger team to do that. But for a product company, probably you can easily scale that part. So as you mentioned earlier, that scalability could be one such factor which can come into calculating the business valuation, that is visible there, right?
Right, right.
Now, my next question would be, Manpreet, that when we are talking about business valuation, we have seen in recent time that even the big companies, they are given the status of unicorn. Millions and billions of dollars were invested into those companies, and within few months we realized that okay, the valuation has come down to a drastic level. So what changes in that few months, like if all the professionals got into the picture and they did their due diligence, as we usually call it, then how come within a month the equation changes so soon?
I would answer it in a way that valuations happen as on a date. So if I am going to calculate the value of vector scale, I'm going to calculate it as of today. What's the thing today? So what's the past history of the company as of today? And based on where I'm standing today, based on how its economy today, and based on how the growth potential seems today, I'm gonna do even the future discounting based on today's numbers, and then bring it back to the today value, and I will say, okay, this company worth today this number. That's the number I gave you today. But tomorrow, if you start making really lousy decisions, you really start taking unethical activities, there's no team, there's a huge disparities between how you are acquiring clients, the client new intakes of client is consistently growing, there's no improvement in the services. It's like you can see that your services has becoming big is becoming redundant, and you're putting no effort into that innovation or that part. Then 1 month after, I will look at your number and it's going to give me a different story, because now your revenue, profits, and everything has been shifted. And the reason they have shifted is the revenue or profits have declined, because in the back, the business fundamental has not been followed. So you did not do the good job in making the sound decision and choosing, do I add this new vertical? Maybe you added a new service vertical, which you thought gonna be a huge profit center for your company, but you did not do accurate risk assessment, and it ended up making the entire loss center, and it's also taking the profit share from other revenue centers you have in the business. So those are the factors that shift the value in few months. It make it seem higher or lower.
Okay, so it clearly conveys that market is very agile, and your valuation is as of today or probably as of this moment, and in the
Yes.
next moment things can change drastically depending on the news and other factors.
Yes, and in fact, even if you look at the stock exchange, that's also giving you a value of the companies, but those also consistently fluctuate. And for the reason that one reason is the absolutely financial, but other reason is how people are how people are holding sentiments for or against the company in that moment, and that affect the PE ratios, which affect the pricing of those value as well.
That makes sense. That makes sense. I see a question probably that's not aligned with the tech talk show that we are doing today, but still, Adoy is asking any tech stock recommendation. Do you have any quick recommendation to make before we move on? Definitely, we are not
Um,
into this kind of discussion right now, Adoy.
no, I would not do any stock recommendation here at all, because the only advice I will say that first understand the business. Don't go by anybody's recommendation. If I say today, okay, buy the stock, who cares? Who am I? You don't even know that the stock I'm naming, if I have put my own money into it or not. So the best advice I would give that go look at the whatever. If first of all, do you understand technology business? That's very important. If a person do not understand technology business, then try to find somebody who understand the technology business and ask them that, hey, help me understand how technology business work, how they get the revenue, how they get the profit, what's the general average cost for them, how much the profit margin are there. Once you get start decent understanding, then you start picking your favorite companies or stocks, and then start reading their financials. Everything is there in their annual reports, and also on the what other people are saying on the internet about those stock, and then start making common sense related knowledge and connecting the dots that, oh, I feel like company is saying that this is what they're saying, this is what their quarter to quarter earning reportings are recommending, but this is what market's saying, so why there's a gap. So a lot of homework to decide on that, but I think that's the right approach to go by.
Yeah, that's a very suitable advice, Adoy. And definitely, as we all say, that before earning, focus on learning. So one should focus upon learning the market that they are entering into, and then focus on other things. Yeah. Manpreet, before we had this question, you were talking about the sentiments, that sentiments are also involved. As you have
Mhm.
done multiple business valuation for companies, you ever faced a scenario where probably the entrepreneur is too emotionally attached to the company, and in their mind the valuation is something different, but when they see an external person arguing with them on the just the numbers, they are behaving differently. Have you had any such emotional discussions with entrepreneurs?
I think I would not be, just for the sake of keeping my NDAs checked, I would tell you my own story. So when I look at my business valuation and I
Yeah.
shift the caps between being an entrepreneur and being a so valuer hat, I do feel that internal fight as well, because I, for me as an entrepreneur, my baby is best. For me, my baby is like nothing can match my baby's strength and everything. My business is like my baby. It's like, okay, you are the best person out there, you are the best services, but when I wear the valuer hat, I really have to discount for that. Okay, what's so great about the service? Where is the market share? How much market share I'm accounting for? Whom am I fighting? The people who are holding 60% of this market share, and I'm just holding in the teeny tiny proportion. What value I'm seeking for? So there's always an internal, for an entrepreneur or for a business owner or founder, there's always going to be a little bit sentiment for their business, because if they have started it from the scratch, putting their own time and investment, it means a lot always to them. So sometimes seeing that emotion getting converted or described by a number is seem to hard to digest, that, oh, is this my all my hard work just worth this much? But there comes the part of being irrational and rational as well.
Uh, yes, that's so true. That people are emotional at the end of the day. Even the entrepreneur is emotional person, and they have this emotional attachment. Manpreet, my next question is that you must have seen that few entrepreneurs doing under evaluation and few others doing over evaluation of their brand value or the company. So, what are the common mistakes that you have seen people making in their business valuation, and what's your take on it?
Okay, so before I answer this one, I would like to add one more thing to the last one, that
Sure.
how it get corrected and the subjective emotions of entrepreneur get corrected. Because if I'm entering into a transaction, let's say if I'm entering into a transaction of business sale or my equity stake selling to you, it's not that my valuation, the person I hired, that is going to be final. You also going to bring a person who is going to do valuation from your side, and my person going to do evaluation from my side. And there's definitely huge chance that their valuations is going to be different, because I obviously want the valuations to be higher so I get the more money. You obviously want the valuations to be lower or justified so you pay less. And that's where they go into the court and they fight for the values and they justify that, okay, based on this is the thing, and based on this is the thing. So that's how also the subjective emotions of both side of founders get taken over. But this also comes into the picture of undervalue and overvalue. So you as a buyer may always complain that you are overvaluing your company because you're selling it, and I will say that no, I am actually undervaluing it, because at least I'm worth it. This much is worth it. This is going to make you so much money in the future. So, can you repeat the question again now?
Yeah. So my
The mis-
question was regarding the what are the common mistakes that you have seen entrepreneurs doing while doing the
I
business
would not call
valuation?
it the mistake. I would think that the difference of opinion comes from, again, taking the different parameters. So if I believe my future revenues should grow at a 20%, but you as a buyer believe that that's too high of a stake. I only see the potential of it year on year growth as 10%. We have a very significant now already a difference of opinion, because 10% difference is going to affect my bottom line revenue now, or in the cash flow now. And I also feel like I do not need more capital expenditure in the future in this business to run it this way. But you feel like, no, but I see this much expansion happening, so I need to put more capital expenditure over there, which gonna involve maybe financing cost, interest cost, and also the depreciation cost, which is gonna lower down the profits. So these are not just the mistakes. I will not refer them mistake, but how we see the growth potential and how we are taking those numbers. Maybe I'm seeing the general average growth at GDP level, but you see that, nah, I feel like this business has more potential with accounting for every expansion and globalization if we take an account for, and you discount it at a different rate and I discount it at a different rate. So all those parameters definitely gonna give a different value for a business.
So that looks like pretty a complex equation to solve. In the meantime, I have a question coming from Nikhil Agarwal, that what kind of challenges do you see in valuation of product based or service provider organization? Any common challenges that most of the time it happens?
I think like we just answer this question as most it comes into the your market share and also your growth potential. So as even if you have a product, so first of all, on the in case of product, in the beginning the cost will be higher because you are developing the product. They're gonna be research and development. They're gonna be testing, they're designing and everything. In the service, maybe the initial cost not be as intense as compared to product capex, but down the line it's also, as you said, the product seems more scalable, because if it's just one product and you're selling it to globally while comparing that one service and providing it to globally. Now in the service segment you need more manpower. Maybe in the product case you use now AI tools to manage those back-end operation, but in the service side you still may need actual human doing the service for you. So that impact now the costing for how much does now manpower cost is getting improved. So it's that basically the operation structure between two which actually create the difference in valuation,
Okay.
I would say.
Okay. Okay.
And other factor also being taken care of, which I would like to mention, that
Yeah.
the products need versus service need, the profitability margins as well, in what it is in the case of product and what it was in the case of service. and also how much the market share you have. Even if you are company offering both, if you have both verticals, you also have a service, but you also have a product design. How much market share is accounting for each? Your audience is more leaning towards your service? Is that where you get more recurring revenues from, or from the product? So that mix, that where your major revenue is also coming, is also going to impact that of this is more valuable or this is more valuable.
Okay. Okay, that I hope, Nikhil, that answers your question. Let me move to the next question. Next question is coming from Bhavna Mia. Bhavna Mia is asking, how do you assess the risk associated with a business during valuation? As you earlier mentioned that what are the risk associated with the business? So could you name some risk and how do you assess the risk?
Yes, I think I had listed down on my notes, so let me pull that out.
Yeah, sure.
1 second. Meanwhile, because there was a lag, so if
Yeah.
you have another question, we can answer that, and then once the thing is open in front of me, I can we can come back on this question
Sure,
if
sure.
you want.
So I have another question coming from Suman, where Suman is asking that can we assume that business valuation is proportional to company stability or growth or not?
Like I said, business value is today's price for that company. If Apple INC, I'm not naming Indian companies for a specific reason. If Apple INC is trading today at a particular price, whatever price trading today, and for the simplicity, just assume it's trading at $1,000 today. Does that? I would like someone you to answer yourself. Does that ensures you that the company always has a stability in terms of their sales? Yes or no? You can answer for yourself, because
Hmm.
the $1,000 of Apple stock today represent that if you want Apple today, buy the stock, you have to pay the 1,000. And now we can fight over it that, oh, this is an overvalued stock or undervalued stock. That's a different story. But that's what they are saying on the stock exchange, that if you want to buy today the stock, you're gonna pay me the $1,000. But what if Apple continue not to do the kind of improvement and innovation they're consistently doing? What if they're not expand as Steve Jobs did? What if they're not bringing the marketing campaigns like Steve Jobs used to do to enhance everything, and also even the product features as well? Then in future, would you buy that product? If no, then that $1,000 wasn't the indicator that you are always, just because you have $1,000 say stock market price today, it doesn't mean that it's always gonna be the sales always gonna go up like this.
Okay.
I
Yeah.
hope that
So
makes sense. And that's the reason
yes.
all the time stocks go up and then there's a downfall as well, and then they rise again, and then because there are sentiments involved as well and financials on one another.
Right. It makes total sense that as the dynamics are changing, as the business environment is changing, it could be external factor, it could be country specific factors. So many factors combine to form the business valuation. I think, and that's why most people are curious, and especially for the beginners, they have a hard time understanding that how do you evaluate the business valuation. And I think that's where the role of professional business valuer like you comes in to the picture, so that people have their own understanding but still reach out to people like you so that they can get the business valuation done from a professional from that manner. So Manpreet, can we go back to the Bhavna's question right now?
Yes. So in case of the risk assessment part, there's first the operational risk involved, which whatever risk can come under the operations. So as simple as if a company do not have SOPs, a basic thing like a basic SOP example I could give you is CRM, having a CRM. If you are not reporting who are your current, there's no system to somewhere report and record that who are the current customer, who is buying when, how much they are buying, how much they are repeatedly buying, when the new business new customer is coming. what are they buying? So if a business is offering multiple, let's say, products, and I'm going a bit of out of the IT example, just to give you an example. Let's say if it's a
Yeah.
retail showroom and you're also selling hats, you're also selling t-shirts, you're also selling jackets, you're also selling women dresses. So which person is consistently buying which of that product of yours? If you have no idea, no systems listed on the business, isn't it a risk for you for a business? It's fast of operation risk, because now you have no idea how to look for that, what our previous customers are buying, which product is actually performing better, and with what customer is buying which product again and again and again, and the reason why they are buying that again and again is also going to give you some input about your product. That maybe they love your t-shirts a lot, but nobody's buying your hats. So that give you indication that, okay, whatever we are doing with our hats, we should stop there and check that why people are not buying. Is it out of trend? Is it the material not good? Is the size and something is problematic with there? Or is the general fashion trend, in sense the hats are not in fashion right now? What is happening that this little segment is not performing while everybody is buying our t-shirts a lot? So this was a small example to understand operations risk. Now, operations risk does not just mean that was a very simple example, not having a complete SOP or system design, but it could go into any aspect of that business operation. And business operation differs from business to business. So that's one kind of risk. Another risk is legal related risk. Is your company's legal disputes are resolved? Is your credit worthiness is okay? Because if on the surface I will say, oh, my company has a huge prospect and this and that, all that jazz story, but inside I have legal disputes going on that isn't resolved right now. So the moment I sell you that business, now that's going to be your headache. So you obviously want to know that, is there anything legally structures are set up and the company is clean on the legal front? Is everything is happening? All the compliances are happening right way or not way? What is the legal position over that? So that's a legal risk factor. Another risk assessment part comes with the market risk, which is the understanding of how much market is going to appreciate this new product. Or again, it's part of growth perspective, that how much market is going to welcome your product in the future. Or if you're and introducing something new, how it's going to be received in the market, how your marketing campaigns are now getting received. Are they getting up engagement or they're getting no engagement? What is happening on their level? So that's also a market risk. So these are the few examples in the risk assessment. How we assess it, first internally you can do is like having your own proper system and everything, but there are agencies who does internal control audits or risk mitigation audits who just do specifically that part. So we always refer to them and they come to your organization and they do all the assessments related to, if it's an operational risk assessment, they should do all the check and auditing about your operations part. If it's related to market risk, we refer to market research agencies to tell what is the relative risk assessment. So these are how you find out and
Okay.
assess your risk.
Okay. I think, Bhavna, that answers your question. Thanks for asking the question. Uh, and we can see, I must appreciate the guest. We can see the internet delay that is happening, but still so many questions coming, which shows that viewers have this interest in this topic and they are getting beautiful insights. Manpreet, my next question would be around that. In your profile it is mentioned that you help business owners to plan the exit strategy. Then what is the right time to build the exit strategy? Because it was coming to my mind that when your business is going up, definitely you are at a higher business valuation, and probably I may not like to sell at that time because business is going higher. And when the business is going down, now I can't sustain it. Definitely the business value will come down, but now I want to sell the business. So when should how entrepreneurs decide the exit strategy, and what's your suggestion on that part?
So, because to answer this question, I will not say there, I will not put it in, any rules or regulation matter that, oh, by that's this time you should plan an exit strategy. And exit strategy could be anything. Exit strategy could be me selling my entire business to you. Exit strategy could also mean me merging my business with you and still keeping the ownership, but I'm not going to work into that. I'm just keeping the equity and I'm merging with you and I'm giving you the employees and team and everything, and now you are going to operate the stuff and I'm going to be the equity and I'll be there with the board meetings, but I'm just keeping the stake. um, Exit strategy could also be sometime buying another business. That's also a exit strategy, so that you are adding new business into your business. Exit strategy would also be going IPO, listing the company and then giving away the some of the equity to the public for them to invest. So anything could be exit. All of these are the examples of exit strategy. What I teach now in my program is I teach two things, and which gonna sound like very contrary thinking, but that's how I think. Because when I started my business, my CEO, who was also my mentor, I had no idea. It was the conversation I was having with him, and at that point of time, I have no idea what business I'm going to start with. And he asked me this question: "What is your exit strategy?" And in my head, I was like, I do not have an entry strategy. I do not have an idea. What are you asking me? So now what I teach is two concepts. One is the infinite mindset. So sometimes when we get into the business, we get it with the very finite mindset that, oh, let's build 100 crore company and then we are done, we are happy. Or let's build a unicorn, that big valuation company, and then we achieved our success and that's done. Infinite mindset says that build a company that's going to live forever. You are going to die. The people who are starting the company are going to leave or die over the period of time. The product and technology gonna get innovated, so they're gonna change, they're gonna evolve with time, but still the company is going to go forever. So while I teach work with entrepreneurs, I teach them to start thinking about their business from that mindset that if my company is going to live forever, even when I am gone, then what kind of company, what kind of product, what kind of systems, what kind of services, what kind of SOPs you're going to put into the picture. And think of the exit strategy. Like now, infinite thinking feels like, which means I'm never selling the business because I'm dying and my business is still going. But exit strategy is also, in a way, I'm not teaching them that, okay, by the next 10 years, just sell your business. This is what I'm not saying. When I say that I teach them exit strategy, all I say them that learn to have all the important pieces plugged into your business. So whenever you do it, your valuations are right. So this came in from my own pain point, and I'm not ashamed to say this, that when I started my, I don't even know at that time I was starting the business or what I was doing. 2 years later, when I had this thought that, what if one day I don't want to run this business? And what if I don't want to do anything? It was just a simple question I was asking myself. But I was asking myself that what is going to happen to all the time and effort and money I'm putting into? Is it going
Mhm.
to go all in vain? Am I going to shut it down and just sit down and then worry about that where the thing is next going to come from? Or even if I'm going to start a new thing, where the funding for that going to come from or what? And that actually pulled me out of from my that whatever I was doing mode to actually my investment banking mode again. And I started thinking like,
Okay.
how much of the business, if I give it this business, whatever it is right now, because it wasn't really in a good shape, to somebody, how much I'm gonna get. And it was a terrible number because a lot of things were not in place properly. So I felt like if I'm gonna go to sell it somewhere, the people gonna laugh at my face that what are you selling? I'm not gonna pay you anything. Rather, you should pay me to buy this stuff. So that gave me the idea that from now on, I need to build a business while I'm still thinking of infinite mindset, that how can I build a company that always going to stay and grow and get strengthened over the time, even I'm gone for the infinite time. But I'm also making sure that from today, what Every single day, what do I do that improves to my valuations? Which is the first number is obviously the profits. So what can I do to improve the profits? It all ties back to revenue and reducing the cost. So if it's revenue, what can I do to give the best customer service? How can I acquire more customers? How can I make a fan base like Apple made, or a fan base that bike company Royal Enfield had? Those
Yeah.
companies have their very strong fan base. Those people are not going anywhere, and that kind of strength you want to have in your revenue line, because people are not want to leave you. So what can I do today to make that happen? And if I'm thinking and asking that question every single day and doing something about that, I'm ensuring that my revenue line is strong. And then I'm also asking, like, okay, what I can do to do it more effectively and efficiently, so I'm not doing or not incurring stupid cost, which is like due to negligence I never paid attention to. How can I eliminate those things that increase my profits? And if my profits are increasing year on year, quarter on quarter, then it's a good sign that if I have to today sell it, then I can get a good value. But the idea is, I'm not thinking that I want to sell it in 5 years or 10 years. I'm not going with the number. I'm working on my business as if I'm going to run this business for forever, and this business is going to grow forever. And to make that happen, I have to, whatever I have to do, I'm going to do. But at the same time, I'm doing things right. So if one day I have to, just like I said, that I'm not now feeling more to work it, then I don't have to worry about. So it's like that survival or thriving mentality. When you ask, like, okay, when people go, everything is going up, nobody is thinking of selling the business, but everything is going down, people are thinking of selling the business. That's a survival mentality. Yeah, everything is going down now, you need money, so you're thinking about it. But when I was everything was going up, you were not thinking with, so because you were not in the thriving mode as well.
Yeah.
So this is the differentiator, I would say. That's how I teach, but that's not the rule. You can decide your exit value whenever you want.
Yeah, that discussion gave a beautiful insight that whether we think of it or not, that life is finite, so there will be a exit strategy. It by nature things are going to go down that way. So in the I know we have gone overboard, but there is a last question I still wanted to pick up. It's coming from Harshit Goyal, and this is going to be last question for our VectoScalar Tech Talk show. Harshit Goyal is asking, what advice would you give to business owners or investors seeking to understand and apply simplified valuation technique? Because people may not have all those professional qualities and understanding of the business. So, any simple valuation technique that they can apply?
Harshad, I would say that number one, go with the business you understand the most. There are so many businesses happening right now: retail, service, IT, manufacturing, and even in these terms, I've kind of labeled a business models. Even in the manufacturer, there's a manufacturing of garments, there's manufacturing of cars, there's a manufacturing of even product design. Then there's a variety of services, construction. So whatever one business you feel like you understand easily, because maybe you know somebody in your family who are into that business, or you have a friend whose family is into that business. So whatever first easy access you can get, and the interest, also the business that interests you, so that will keep it you engaged into understanding more. Find that business and then start learning about, first understand the operationality of the business. You need to understand, okay, what this business is. So if I'm into the road construction business, let's say, I need to understand that what how road construction business work, where the revenue come, because it's a long product. I cannot make the road in 2 days. It's gonna take time. If it's a long stretch road, it maybe my revenue gets stretched in 3 years. So how is that gonna play out? So you need to understand and ask those questions. Once you have that, start simplifying everything. It's very simple. There are obviously technical complications where the finance people come into, but in the end, it's the profit getting projected, that if I'm making today this much profit and I have the potential to make this number of profits for next 10 years, and if I
Okay.
bring the present value of all those numbers, because of inflation and time value of money. So that's, if you don't understand compounding and time value of money and learn about that concept, that's gonna save a huge amount of your own personal finances if you understand time value of money and compounding concept. And then you can, that's the value. Second thing is the second approach which I mentioned, which is the market multiplier, is whatever you were business understanding, look, it's parallel business. So let's say you were understanding phone business because some of your friends are into, or creating app business, they are into that business, and you found like, okay, they're in the market, these are the companies who are on the same strength. So you're not going to compare a very small phone manufacturing business to Apple because of the bandwidth. Their volumes and your volumes are obviously low. So the comparison should always be apple to apple and not to apple to orange. That's also to keep in mind. But again, that's, in that as well, in a very simplified terms, you are taking the profit and multiplying to what multiplier that business will sell. And the book value method is basically you look into the financial statement, what are the assets, what are the liability. If they have to sell it out, you have to realize all the assets. So you sell that assets, you take the market value of everything you're going to sell it, minus the liabilities, you're going to pay off everything you have in the business, and whatever the final value will be the value of business. Now if you want to get into the value of equity, reduce the debt components as well, and then you have a value of equity. So this is a very simplified understanding I gave you. You can do that. The best book you want to read was The Intelligent Investor, I would say, by Benjamin Franklin. Thick book, but it will give you a lot of insights. Or you can read a lot about Warren Buffett's letter to shareholders. They're also very insightful into understanding, maybe not directly the valuations, but understanding the business insights.
Those two are really good recommendation, Manpreet. I must say that, and I can assure Harshit that though you might be looking for a simplified, but you could understand that it's not simple. If it has to be accurate, one has to do that extra little bit hard work. And again, it was good to see that probably our first question from where we started and when we are ending, the question revolve around same, that there are three techniques and one should focus on developing the skills. So Harshit, I hope your question is answered and you can take your learning further by reading more on the recommended readings. Thanks Manpreet, thanks for taking out time to be on VectoScalar Tech Talk show and sharing how to simplify business valuation. Thanks again.
Thank you so much for having me with us, and thank you for the audience for your questions. I hope you get the answers, and despite the lag which is happening, I appreciate your patience with me.
Yeah, and thanks audience, we'll come back with another amazing guest every time. See you and have a nice day ahead. Bye bye.